Hi, welcome to my channel. My name is Gil Rossi, investor and funds manager. Today I'm going to show you my valuation of Berkshire Hathaway. I've done sum of the parts valuation. I've gone through all the pieces of the business, at least the pieces that can be valued in different categories. I've come with a fair value for the business. So there's a lot of ground to cover. I've done it quite deeply. So let's get to it. I hope that this slide is as illustrative as what you'll have after watching this video. I hope that you get a better view of Berkshire. So let's get started right into it. The first thing that we're going to do is see how much cash there is in the bank accounts or in the balance sheet. So we get to the balance sheet of this past year, 2020, and we have three items here that I consider to be cash items. So these three items from the balance sheet will add to $155 billion, and I deduct 30 billion because Buffett always wants to keep at least 20 billion of dry powder in the balance sheet. So it's the minimum liquidity he wants to have, and for the safety of running the business. I'm going to subtract 30 billion to be on the conservative side here. So we have $125 billion of cash. Then in the same balance sheet, the next line we see here is investment in equity securities, and this is $281 billion. This is the value of all the equity in the portfolio, Coca-Cola, Apple, Bank of America. And this is the way I see it. I put it $281 billion in the same number in my valuation, but I will deduct it by 15% because I think that most of these businesses are a little bit on the overvalued side. And the way I do it is, if you see here, these are the 10 largest positions in the portfolio. Apple is 43% of the portfolio, so that's $122 billion worth at the end of 2020. Then you have 11% Bank of America, and the 10 largest add 85%. So it's a quite concentrated portfolio that he runs. So I did a quick valuation of each of these, and I got the 15% overvaluation that I was talking about. So I'm going to add 243. And then because Buffett invests and produces capital gains, unrealized capital gains, like Coca-Cola, American Express, those are companies that he have held for many years, and they have appreciated in value quite substantially. If he were to sell all those companies right now, all the companies in the portfolio, he will have to pay $40 billion to the US in the form of taxes, of capital gain taxes. So this is a liability that has to be considered. What I do is the following. This is the deferred tax liability, but because I don't think that Buffett is going to sell everything today, he probably will never sell it, who knows. I'm going to assume only 50% of that. Because if you have to pay $40 billion in 10 years, that gives you the benefit of investing that $40 billion for those 10 years. And in Buffett's hands, that will be worth double. So at least, so what I'm going to do is deduct it in half. That gives us the sum of all these parts, which are what I call the balance sheet items, because all these numbers come from the balance sheet, are going to be roughly $350 billion. So now let's get to the more interesting and difficult part. Berkshire, as you may know, is a collection of not only the securities invested in the portfolio, but also 62 fully owned businesses. And you have all these businesses owned. These are amazing businesses. Each and every one of them is an amazing business, really. I've used many of the things that some of them produce. Like I have a pair of Justin boots, which are great. I use, as you see, fruit of the loom with the Berkshire logo and stuff. And these are all the 70 businesses or 60 something that he used to have at that moment. What we're going to, the way we're going to approach this valuation is we're going to divide it in 4 businesses, 4 groups, the same way that Buffett divides that in the balance sheet and in the annual reports, and that will give us more information. We cannot go business by business because we don't have enough information for each of them, but we can arrive to I think a pretty decent valuation, you'll see. So we will group the 14 insurance companies in one main group, then the manufacturing, servicing and retailing in another big group of 45 companies. Then we have utilities and energies, which is Berkshire Hathaway Energy, which has roughly 10 utilities and gas transportation pipelines. It has transmission lines, companies, renewables. It's a great business in itself, really a great business. They put here Home Services of America as part of Berkshire Hathaway Energy, which has nothing to do with energy, but I don't know why they put it there. And then we have one railroad, which is probably the largest railroad in the US in volume terms. Our job is to value each of those 4 portions of the business. So we will start here by the net earnings, page K33 of the annual report, results of operations, and this is after taxes. We have here insurance, these 2 lines, then railroad and utilities and energy, manufacturing, services and retailing, and then we have these 2 which are not important for valuation purposes for us. So this is the earnings that each of those four businesses produce. So let's get to value each of these. First of all, let's start with the valuation of the railroad. For the valuation of the railroad, what I did was I went back until the moment that they bought it in 2010, 2011, and I compiled all the information that you can get from the previous annual reports. And you can see here revenues, they have stayed the same. Then you have all the expenses, and you have pre-tax earnings. And there's an interesting thing here, which is that the operating ratio of the railroad, which is a very important metric to check whether a railroad is an efficient operator or not. And this shows 73% of the income of the revenue was expenses. And you see that the expenses are coming down. Now they are 62. So even with the same level of revenues, you see that the pre-tax earnings are going up. So this is a good sign that they are getting better at running this business. I'm going to, because the Burlington Northern Santa Fe Railroad is very similar to Union Pacific, and they even run in the same area of the United States, or all the West. They are very similar in size and everything. And Union Pacific is a public company. So I'm going to use Union Pacific also as a proxy to check on my valuation with the Burlington Northern Santa Fe. And you see I did here the same for Union Pacific. And you can see that the revenue of Union Pacific is very similar to the Burlington Northern Santa Fe. Very similar. But they were a bit better at operating. In fact, today they are operating at the 60% ratio, and apparently it's going to go even lower, because they are implementing sort of like new systems, innovative systems that have been implemented in many railroads, and that's bringing the efficiency up. But if you see Union Pacific versus Burlington Northern Santa Fe earnings before taxes, they were doing with the same level of revenue a bit better than here. You see, I compute 4 billion here, 4.7, and they were making 5.2 with the same revenue. But if you see this this is 11% better Union Pacific, but if you see, it's trending towards even. So what I'm going to say now is that Union Pacific and Burlington Northern Santa Fe are roughly valued at the same level. For me, at the same valuation level. So if you see the market capitalization here of the Union Pacific is $141 billion. That's 20 times earnings. I did my own valuation of the Union Pacific because I owned the Union Pacific in my portfolio as well, and it's a great company, and probably I will keep it for a long time. But let's see here. This is a result of my valuation. It's mainly on the final table, where I see that if I pay 100%, I will get a 9.3 return for owning the Union Pacific. I prefer to buy when I get close to 10%, 10-11%. So for me, 90% of the current value would be the fair value of Union Pacific. So roughly 85-90%. So this is what I did. The 141 here, and applied the valuation that I did. It's giving me 127, which is 90% of that. See, this is the number that I'm going to use. Another check here, which is an important check for Union Pacific valuation, is what we get here. We got here in the annual letter that Buffett published a week ago, and he talks about the valuation, the main drivers of valuation for Berkshire, which are 4: insurance, railroad, energy, and the fourth one is Apple, his stake in Apple. These are the largest pieces of value that Berkshire has. And what he says here, his second and third most valuable assets, pretty much a toss-up, he says, are Berkshire 100% ownership on BNSF, which is the largest railroad measured by freight volume, and the 5.4% ownership of Apple. If you remember, when I showed you the portfolio, Apple was 43% and it was valued at 122 billion. So in my case, I'm valuing Burlington Northern Santa Fe at 127, which is the same as Union Pacific to me. So 127, it's in the ballpark, and it's in line with what Buffett is saying here, that his second and third most valuable assets are pretty much a toss-up. So to me, 120, 127, 121, something in that range is what Burlington Northern Santa Fe is worth. Okay, now let's go to the energy business. The energy business, what I did, I took large public utilities in the US, and I compiled price earnings, price sales, and operating income, and price to operating income, and came with an average for the industry. This is Berkshire Hathaway Energy. Sales 21 billion. That sales, I can take it from here. In the page 4K113, they discriminate business segments, and you can see here Berkshire Hathaway Energy revenues 21 billion. So this is what I'm putting here, 21 billion. 3 billion net income of Berkshire Hathaway Energy, and this comes from here, the one that I showed you earlier, which is 3.091 utilities energy. This is the net income. So the net income, I put it here. And the operating income, I'm taking it from here as well. Here, because you have earnings before income taxes for energy, which is 2479. If you add before income taxes, but after interests, if you add interests back, which is 1.9 to this 2.4, you get 4.420. This is the operating income. So if you see what if we valued Berkshire at the same level as operating income of 11, we will get 50 billion almost of capitalization. If we do it based on sales, we'll get 48. If we do it based on the net income, we'll get 50. What I did was an average of all this, and I have 49. And there's another check, which is a good check. Berkshire bought in March 2020, very, very recently, a few days ago, 180,000 shares from a family, Scott family, at a certain price, blah, blah, blah. This gives a valuation of Berkshire of 53 billion. So Berkshire paid the equivalent of 53 billion to buy a portion of Berkshire Hathaway Energy. So to me, using 49 is a good check. So that I'm comfortable with that. So now let's look at this canvas. This is a beautiful canvas full of companies, great businesses, all of them. We cannot value them, as I said, individually, but I'm going to use proxies as well, the same way I did for the utility. So what I did was I collected a bunch of similar companies as a group, and all of them public companies, and I again took price earnings, price sales, forward price earnings, and price cash flow from the public information. This is the average of all these companies. And this is the value of manufacturing services and retailing. This is the in earnings, and the earnings, again, comes from here. The page I showed you at the beginning, 8.3 billion. So this is 8.3 billion I put here. So if I multiply that by 29, I would get a market capitalization of 243 billion. In terms of sales, I do the same. If we go to this one, we have the sales of all the manufacturing, McLean company, and servicing, all these three. If you add these three in revenues, you'll get this number, 134. And if you multiply 134 by 3 times, you get 400 billion share fair value, which is, I think, this I wouldn't use. It's too much. There's something here going on. Then in terms of forward price earnings is the price divided by the earnings next year. And I'm going to use for earnings next year the same as earnings this year. So I'm being conservative there. If I multiply that by 23, I get $165 billion of value. And the same thing with the cash flow. I can calculate cash flow from here. If you go further down, you will get the capital expenditures, and so you can make the calculation. 18 times I multiplied that by 270,000. Well, what I'm doing here is I also did a check on the valuation of all these companies, and I think they are 15% roughly overvalued. So I'm going to multiply all these numbers here by 0.87 to give me a closer amount to fair value. And I'm going to take just the smallest one, 165. So this is no average, nothing. This is I average for 400 billion is nothing of relevance. So I'm going to use 165. So this is it. If we go back to our table of the value of Berkshire so far, we have been here in balance sheet items, 350, and then railroad, which is here, 127 here. Then utilities, 49 here. And the last one, the one we just saw, the 165 billion of manufacturing and services, gives us 341. So this is roughly 680 billion what we have so far. We haven't even touched insurance yet, which is our next step. This is the insurance business. 13 great companies, all of them running with a perfect financial position. They have an advantage versus the competition because they can invest the money that they get from premiums, and I'll go a little bit in detail in a minute about the float, which is all the money that insurance companies have that get paid in premiums. They can invest it, and they can make money in that. Normally, if you're an insurance company and you're only an insurance company, you cannot go crazy investing that money because you cannot go too volatile because you never know when you're going to get a claim. So you can only invest in fixed income, most of it. And today, investing in fixed income is a disadvantage. So what happens with insurance companies, they try to make up that disadvantage by lowering premiums and making more risky bets on investing and more risky bets on the insurance side of the business. I'm going to explain a little bit in a minute. But what I want to tell you here is that Berkshire has a better position than the competition, to not only because of the culture, the way they manage the companies, but also because of this investing advantage. So let's explain a little bit the insurance business. We have two main components: the underwriting, which is the business of insuring, really, where you get premiums and you subtract the claims that you have that year and the operating expenses, and that gives you an annual profit or loss. That's the underwriting business. But because the premiums that you receive don't need to be paid, they don't get claimed immediately. Normally, they get claimed in the future, sometimes many years in the future. Then you get to invest what's called float. So all the accumulation of these premiums that you are having in your possession as an insurance company, but you're going to pay use someday to pay claims. Who knows when it's going to be? It's going to be in the future. On average, it's two years or so. So you get to invest all your revenues, all your premiums for 2 years on average. That gives you the float. I'll show you the premiums in this line here. You see the premiums are 63 billion. So this is all the revenue, 63 billion. If you multiply that by 2, it gives you 138 roughly, which is the other thing I want to show you, which is the float. And here, from Buffett's own words, this collect now, pay later model leaves proprietary and casualty companies holding large sums, money we call float, that will eventually go to others. Meanwhile, insurers get to invest this float for their own benefit, which is what Buffett has been doing. So even if individual policies and claims come and go, the amount of float the insurer holds usually remains fairly stable in relation to premium volume. And this is what I was telling you. Premium volume is 63 billion, and the float, as you can see here in this table that Buffett shows us, up to last year it was 129 billion. This year is 138 billion, so roughly twice the premium volume. And what happens with this amount of money? Buffett has created all these beautiful businesses, really. All what you see here, this 125, this 243, this 348, this 341, all that has been created with float and with the reinvesting of profits within their own businesses. So that's how valuable float is in the hands of a person that can invest it properly, like Buffett, or even you don't need to be a crazy investor. Even if you get market returns, you're going to have tremendous value from float. Okay, so this is a little bit about float. So how do we value an insurance business? What I'm going to do is the underwriting portion. I'm going to value it at 2.5% the premiums, which were 63 billion that we were talking about. That gives us 1.6 billion. And if you see, this 1.6 billion is a little bit higher than what they have been getting in underwriting. But on average, they get, if you go back 10 years or more, they get roughly 2.5% on average. So this is why I'm using this. And we multiply that by 15, which is like a price earnings ratio for an insurance company. I have 24 billion. This is the underwriting portion. What about the investing portion? The investing portion for me is exactly what I just showed you. This plus this, because this is what the investment portion of the insurance business is worth today. So this is all the value that has been created with this money. So of course, I have already computed this investing value. So then some people say, okay, what about float? Don't we have to subtract float? Because float is a liability, something that you have to pay someone, like any other debt. If it were a bank debt, I would subtract this 138 billion from the calculation of value, of course. But it is not debt. It's interest-free loan. You don't have to pay any interest, and it has no commitment to pay it back anytime soon. As you can see, it has been increasing. If you assume that the business stays stable or grow, float will always keep growing. If one day float has to start decreasing, Buffett talks about that in his last year letter. If you see here, Buffett says, we may in time experience a decline in float. If so, that decline will be very gradual, no more than 3% in any given year. So to me, float could start decreasing probably, but very slowly. But if the business keeps growing, float will keep growing, and that additional float, because the float that we on the past has already we already put it in the value of all these companies. But the future growth, all the future incremental float that we're going to get from now on can also be invested. And I did an exercise. Let's assume that float grows at a 5% per annum, and then it's going to be invested at the 5% per annum. So this incremental float for 2 decades. Let's assume 2 decades of 5% growth, and then 0 for 2 more decades, no more growth. So the business starts to sort of like mature. And then at the end of that 40-year period, we have to pay back all the float that we have, which you'll see in my calculation is like $500 billion. And this is the calculation I did. It's just an exercise, but it's a good exercise because it tells you that what the value of float is. It's quite valuable. Float is not a liability. Float is an asset that can provide, in my case, in this calculation, even using an 8% discount rate. So every earnings that we get in the future, we discount at 8%. It gives 43 billion of additional value, and this is the way I calculated it. It's just an exercise, but it's an exercise that shows me that float is not a liability. Float is actually quite a large value, because all these assumptions are quite, I think, are not impossible to achieve. Okay, so then if we have this, go to our final fair value table. We had the balance sheet 350, the non-insurance 340. Now the insurance that I'm telling you right a minute ago, these two things gives us 750. This is on a per share basis. So on a per share basis, I get $327 billion, $327 of valuation per stock of B shares. And today, this is what they are trading, 251. So you see, even if you deduct the insurance operation and you say 0. Insurance operation, we are not going to consider it. We are not sure whether they'll make money in the underwriting operation, so let's deduct 10. And I'm not sure that I don't buy your example about float, so I'm going to deduct 19. Okay, so even if you deduct this, is 300. And remember that I did quite a conservative analysis on all these things. So let's say 300, and you can buy it for 250. I think this is a great business. It's not very well understood in Wall Street. That's why it's not valued fairly. But the good thing is that this is a value-creating machine that has been built by Buffett. And even when Buffett is not here, when Charlie Munger is not here anymore, this machine will keep working. And in 10, 20, 15 years time, even if the price will not be exactly fair value, the price will keep going up towards fair value, because fair value goes up. So if you are here, let's say we are 5 years behind price versus fair value, who cares if I'm going to hold this for more than 10, 15 years, who knows, even probably until the day I die. So this is my valuation. Hopefully you like it. If you have any comments, please make them. If you have any questions also. If you don't agree with me in some of these calculations, I'd love to know. And at least I gave you my reasons and my reasoning of why every single number here has a reason to be. And I'm feeling very comfortable with 300, 330 valuation for Berkshire. I'm going to keep buying and come on, let's go. Okay, Berkshire. So I hope you enjoyed the video. Give it a like if you like it, and I'm going to upload more videos soon, so stay tuned. Thanks very much for watching. Bye bye.